This is episode 240 of Zen and the Art of Real Estate Investing with my guest, Paul Moore. Paul is the founder and managing partner of Wellings Capital. They are a real estate private equity firm that provides accredited investors with access to a diversified portfolio of recession-resistant assets, self-storage, manufactured housing, multifamily, light industrial, and more. Paul is also the author of the book, Storing Up Profits and the Perfect Investment. Paul, welcome to the show.
Great to be here, Jonathan. Thank you.
Yeah, I'm excited to talk to you and get your expertise, which is really varied. But I want to start with something really interesting that I read in the form that you sent me and something that I've believed in for so long. Why is the word no so important as investors and also to you guys at Wellings?
You know, I sold my company in 1997 to a small public firm, and my investing mantra after that was, yes. It has to prove itself really hard for me to say no, and even then, I might still say yes. And, I wasn't an investor at all, Jonathan. I thought
Yeah.
I was. I was actually a speculator.
Ooh, yeah.
And I was disguising myself, lying to myself that I was an investor. That was back in 97, 98, 99, and after that, if I can admit it. And so I made a ton of mistakes doing that. And later, I discovered people like Warren Buffett, who specifically said, let me get this quote right. He said, the best investors say no a lot. The very best investors say no almost all the time. And so it is critical to have a default of saying no and to make something absolutely jump through hoops, cross every hurdle and say, prove itself to say yes. In fact, our company reviewed 745 operators and deals last year for our fund, and we said no to 740 of them, which is 99.3%. And that was very expensive. It was painful. We have one that we already have taken a deposit for, and I just got word an hour ago that it's almost certainly dead in the water. And that means our whole team has to go find another deal today.
Yeah.
And in the next couple of weeks. And so it's painful, but it's important because so many deals, there are so many deals available. I'll say that. And it's so easy to say yes, just out of convenience, especially if you're a busy professional.
Yeah,
a lot of our
exactly.
investors are doctors, dentists, IT professionals who just want to, wire money and move on. And it's just critical that you just take the time to have a default of saying no.
Yeah, I completely agree. I've always said that the biggest power for real estate investors, just in any context, is the ability to say no, walk
Yeah.
away from something. And it's become even harder because you had that trouble in 1997 by saying yes, but now with like the internet and everything being AI, everything looks good. It's really hard to understand why people would take in the information and then choose to go the other way. But then there's the ego.
Yeah.
The ego and all of the opportunity is out there. And as we both know, it's happened for me too. Ego has played a role. And especially like you said, after you sold your company, the money's there. You feel like, hey, I can make a lot of good investments. Why did you make bad investments at that time compared to what you know now?
I'll tell you why. Because I wanted to get the same thrill out of investing I got as an entrepreneur. I was bored. I had made, some money selling my company, and I got bored pretty quickly, sitting at home trying to be the best father, the best husband, the best
Yeah.
friend that I could be. That's a quote from me in 1998.
Yeah.
And I got bored and I thought, well, I should get the same thrill out of investing that I did out of being an entrepreneur. And I became what I now call an entrepreneurial investor. I love the thrill of the chase. I love staying in startup mode all the time. I love knowing half of the information I needed to know to succeed. I love repeating the learning curve. I apparently loved having a very broad but no deep knowledge of any one subject. I apparently loved trying to hit a grand slam and striking out most of the time.
Yeah.
And I apparently loved the prospect of eventually living in a mobile home. if I hadn't changed my ways. And there's nothing wrong with living in a mobile home. No
Yeah, yeah.
offense to anybody, but my point is, it's probably not the way most people, set their aspirations on at 34 years old when they sell their company.
So when you're looking at operators, I know you said that it's really only about 20. What's the most important thing you want to see from an operator when you want to start with them, when you haven't done business with them before?
Well, we have a 27-point due diligence checklist. And, I am not sure I can answer that because there are so many important things. You would think that, maybe the criminal check and the background check and the reference check would be most important, Jonathan. But if those all are perfect, yet they're using risky floating rate debt, we'll walk away.
Yeah.
And if they're using the right kind of debt, we might walk away because we found out that they didn't tell us the truth about something. We do an NOI audit. And when we do the net operating income audit, we might find something drastically
Yeah.
different than they told us. And so we'll walk away because they didn't tell us the truth. We'll walk away based on a gut check. Everything looks good, but we went to visit them in person and just had a funny feeling that there was something wrong. We might walk away for that. So it's hard to say.
Yeah, and becomes even more important when you're caretaking other people's money as
Oh,
part of the
no.
deal. When it's you or when it's me, we can make mistakes and you can kind of assess your own willingness to take a risk. But once
Right.
other people are investing in you, you need those 27 points to assure that they're going to be safe as well.
That's exactly right. And that, if anything would ever keep me up at night, it would be, using other people's money. I was $2.5 million in debt in 2007 on the eve of the great financial crisis. And I never lost any sleep that I remember over that. I was debt free 13 months later, by the way. It was a crazy story.
Yeah.
But if it would have been other people's money, I don't know how I could have done it.
Explain the private equity for somebody who may be newer to it, because as you were saying, you're taking in capital and then you're investing with other operators. We've had a lot of just traditional, either property syndicators on, we've had fund of funds, we've had family offices, but explain the private equity setup and what investors get through you guys. I think that will help them understand how it works.
Yeah, Jonathan, I don't know how many of your viewer or listeners are actually watching this, but
Yeah.
for the few that, or those that
Yeah.
are,
Yeah. Yeah.
I don't know what percentage, but this is a graph showing the 80-20 rule. It's also called the Pareto curve or the skew curve.
Hmm.
And this is success and margin of safety over here.
Yeah.
And this is operator or deal down here, okay, on the y-axis,
Yeah.
on the x-axis, excuse me. So if the average investor will invest with the average operator in the average deal, and then on the y-axis, they'll get average results.
Yeah. Yeah.
Our theory is because the curve, for those who aren't watching, goes up and to the right in a skewed manner, that excuse me, I'm trying to multitask here and try to do this in reverse.
Yeah. It's
If
working
you,
on video, so don't worry about it.
okay, good.
Yeah.
So if you invest in the top 20%, or better yet, the top 20% of the top 20, in other words, the top 4%,
Yeah.
you will be like, your results will be much, much better. I'm not going to say they're 4 times better as this
Yeah.
graph looks like, but they're much, much better than the average. And by being much better than the average, they're going to be much safer when the tide goes out. The rising tide lifted all boats from 2012 to 2022. But Warren Buffett, as he's often said someday that tide's going to go out and then we'll see who's skinny dipping. And then, of course, the 11 interest rate hikes in 16 months
Yeah.
were not the problem, but they indicated the problem. In other words, they showed who was skinny dipping, because all the people who were using risky floating rate debt and assuming that trees grow to the sky and all that stuff, they were all exposed. And that was really tragic. So what we did is we thought, well before that happened, years before that happened, we designed a company that said, we're going to try to find, if we can, there's no guarantee we can succeed, but we're going to try to find those operators who are in that top 20%, or better yet, the top 20 of the top 20, the top 4%. And by doing that, stay way above that tide when it goes out. And so far, we've had a lot of success with that. 73% of our investments in 2024 were from repeat investors. So that made us pretty happy.